long. What they say is as 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 long.
I'm getting a. I'm getting a. I'm getting a. Me. I'm getting a 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 me.
There, fixed it.
There we go.
As there's a open screen somewhere that we created a loop, and since I'm sharing everything,
those pesky tabs, man. I'm like,
yeah,
like, okay, which one has the sound bar, the little sound thing on it? You can't find it.
I know. I'm like, where is it? Where is it? There's an
know.
open window. Plus, it's spooky because it's at the market top. Now,
right, because you're in the canyon, right? It's just the echo that's going out. Market top, market top, market top.
Yeah, and do you like this image? The image actually has a lower high, and I'm going to talk about that today as well. But I don't want anyone to be afraid of this. The idea that it's a market tops can just simply tell you we might be going into a holding pattern for a little while. I'm not talking about this major collapse yet. It could be like this other rock over here, this second rock, where it's only going to need a little budge and it might be tipping over. There's not a lot of foundation. I don't know. I just pulled up the image.
There's in down by Bend, Oregon, it's called Smith Rock, and it's a famous rock climbing place, and they have this monkey face, but it's kind of like that. It's just sitting on top, and people go up there and like they go in the mouth of it. I'm like, I don't want to be on top of that head with that little pinnacle.
Well, the double arch collapsed at Lake Palace, so you never know.
It did.
So you have something that you've trusted all this time, and it creates this. There's a nice top wink that is there, and it's got this kind of bowl that was cut out of it, and it collapsed down. Hundreds of years, no one was on top of it. People were near it when it happened, so it got on video. But that's the thing, is that you don't know how much foundation's there, and whether that's going to hold for another 100,000 years or a week. And so when we're pushing up to those key highs, it could just sit here. We could sit here for a very long time. But there's some key things that are different and that have kind of been building. And it will always sound like we're looking at this and saying the market's got to go into recession. And maybe it does. Maybe we do have to see that. But there's some key things that have happened over the last week, over the last month. And I think one is the volume and the volume. We maybe need some volume too. Some volume into this last rally, some fundamentals of the stocks, and some things that have changed. We're going to be talking about some key ratios there. And we're going to talk about some further economic conditions that are going on into this market. So can we just kind of go with the S&P yesterday alone to start out with? Just the view of what this looked like. Now, we'll get into some of the taken money flow and some other volume indicators here. But as you can see, the broad market, ES, falls down, rallies back up, and kind of just chops in here in the middle. And that's fine one way or the other. But this is the big supply area that we've been watching. And as you look at the difference in this sell-off and the volume, and this rally and the volume, it's taken the same amount of time, creating what we would normally call a V-type reversal. But the volume has never even got to half of the volume that was occurring in the sell-off. So in the big picture, that's not there. But have you ever seen this spike of volume late in the day that was this dramatic multiple times?
Yeah.
I was looking at that, and I went back and tried to find that similar kind of thing. And in a downtrend, that's one thing. And trying to turn into an uptrend and a rally, you can see these volumes were equal and greater. And to have these happen not during an economic day, we didn't really have any significant economic reports later in the day. They're all pre-market. And you look back and you can have it at the close, but usually you're at about a third of the volume by the time you get to the afternoon. End of the day, that's just repositioning. Just so you can say that last spike is just closed. Don't worry about that one. I'm talking about during the regular trading hours.
Yeah. Yeah, market and close stuff is irrelevant, right? So you see those market and close orders and make things up. Like, it doesn't mean
I'm not
anything,
looking at this.
right?
I'm looking at this.
Yeah. But that's the thing is, we saw that, during the sell-off, you see the failure late in the day, and to see that at this high right now, that should raise some level of concern, right? That we're just failing to kind of keep that momentum, or even just seeing that there is some selling coming in with size. And again, this rally since the 5th, it's all been on what? The idea of Fed rate cuts. It's been the dollar losing value, driving prices up. in real terms, this rally is not very big if we put it in gold terms, right? So if we discount the effect of a diminishing dollar, this is not a big rally. We're not back at highs in dollar terms. We're just there in price terms because the dollar's lost a lot of value and it's helped push stocks higher, but it's melting up on light volume.
Well, in addition to that, this is the S&P. Let's go take a look at the NASDAQ, because we know that a lot of this was driven, and yesterday it was driven based off Nvidia. And I'll put in let's put in the September chart just so I can get rid of my drawings there. So when we're looking at the September chart, I do want to talk about this gold and copper ratio I talked about in yesterday's video. But as we're looking at these moves through here, this is all it did is push from end zone to end zone, distribution to distribution, probability to probability, which is not uncommon. And we have been stuck here since the 15th. Yeah. So half of the month we've been stuck in this area. And yesterday we saw a nearly $200 billion loss of value in the NASDAQ alone. Just the loss in sorry, not NASDAQ, Nvidia alone. Yeah. So one stock that's been driving the market that accounts for 24% of the NASDAQ, this sell-off, this reversal on higher than normal volume 2 days in a row after being stuck sideways, this, even though it didn't break out, that buildup of pressure and trading through the low ahead of the breakout and ahead of earnings, that's a lot of volume. We're talking about 448 million shares, 453 million shares. And if we go back, we had that kind of rally back here, but that was on a gap down.
Yeah.
So this actually is a big red candle. It's negatively closed from the previous day. This one is negatively closed. So that should be red, red, red. So all the volume that is up here above 450, 470 million shares in volume that were that high of trading have been negative for Nvidia. And we accelerated this, and that was $200 billion of lost value on a $3 trillion stock. So we were 3.3, now we're at 3. We're liquidating value.
Nvidia's tried to move up after hours, is kind of giving it back. I mean, look, what we saw on Wednesday with Nvidia's earnings, we talked about it after the close, just looking at it. I mean, you saw the options market pricing in the downside, right? For the first time this year, we're saying, hey, the bigger move in Nvidia is down versus up. And most of the stuff in the report looked like it was going to be positive. And in the end, the reaction was negative. And that reaction is very telling. When you start to sell off on size, it makes it much more difficult to climb back the hill. We might retest the high, but the fact of the matter is the pressure is to the downside. And as you're showing there, you start to move through that zone. We go to the next zone, which is 100.
Yep, 100 is the next mark. And by the way, you might look at this and say that it was just traded flat up here. It was touching fair price. The market had evaluated this as fair price, not overbought, oversold, just balanced. So we already balanced the market and then sold off. So this is not just a pullback. It's changing from balanced to overbought. That's what that red area would mean. And now if we clear 115, we're going to 100. It's just how the distribution models work. And so we are seeing deployment of capital, or not deployment, selling of stock here and collecting of the capital and going into cash as the dollar recovered a little bit yesterday as well. But it's not just Nvidia, is it? We saw, go ahead.
No, go ahead.
Nope. I was going to say we saw the ratio shift around quite a bit too.
I was going to mention, we're talking about stock, but we're talking about companies that have a lot of cash, like an Nvidia, right? Generating tremendous free cash flow right now anyway. But the fact of the matter is, and when you look at stock buybacks, it takes cash to buy back stock. Right now, cash as a percentage of total assets in the S&P 500 is 8.8%. That's the lowest since 2009. So, the fact is companies in general in the S&P 500 are a little bit cash strapped right now. They would have to borrow money at high rates in order to be able to finance those buybacks and dividends. And so while some companies could be in great shape like an Nvidia, generally speaking, the S&P is not. So buybacks are potentially in jeopardy here. And when you're seeing Nvidia pressured like it is, again, we're seeing a lot kind of tilting to the downside right now at a point where it's retesting resistance in the S&P.
Yeah, now this is one of the things that you've used before as far as the economic financial ratios that are going into the valuations of the companies. And so And I actually had this pulled up coincidentally. I wasn't even going to show it, but I was looking at this myself and looking at the M2
Mm-hmm.
compared to the previous year. So we spiked up here. No surprise there that we just pumped a ton of money into the market.
Yeah.
And from the previous year, we dropped to negative 600. So we, in essence, took out so much money out of the market in that time period that we really reversed all the way through the zero line. We've never seen this year over year change that dramatic. Now we have bounced up since January, so that was the low as January. But it's interesting to me. You said that money is a key thing, and money supply and available cash could be interesting for those buybacks. We did bounce off the lows, so we've gone from negative 600 to negative 200, but we're still down $200 billion from last year.
Yeah. I mean, on this too, I mean, the Fed balance sheet went up to almost to $9 trillion, where the previous high was closer to like 4.5 or 5. So, I mean, we're going to get big swings, but this is the complicated effort is if you're a trader, if you're looking at the market, you're trying to price in this kind of information. It's like, we've never seen this amount of money in the system. And so when does it eventually start to come home to roost in terms of the Fed's missteps throughout these number of years? The Fed is boxed in a corner. It's the Fed conundrum because we have so much money sloshing around. But again, it's the pace. It takes further increases in monetary stimulus to be able to keep the ball rolling. Otherwise, it starts to roll back. And when you see $7 trillion start to roll back, that's out there in who knows what, debt, et cetera, now all of a sudden you see the potential defaults. I mean, all this stuff. I mean, credit card debt right now is, I think it's the highest it's ever been in terms of the default rate, or highest since 2008. We're almost nearly 8% right now. There's so much stuff that could start to roll back and really start to crush us.
I've got so many, like I said, so many tabs open. That's why I was looking for the mute. So yeah,
well,
so
at least
the
we were playing
delinquency.
the Tim and Kamala show last night.
The who? What?
The Tim
Oh
and
yes,
Kamala. Sorry, Kamala.
Kamala. You lost me there.
Well, she's used both in the past. She's called herself Kamala and Kamala, but it's Kamala Harris and Tim Walz's interview last night on CNN.
Yeah, we don't have time to digest that. So we'll continue on. Delinquency rate of credit cards at the highest level they've been at since 2011, pushing through the higher levels. I thought this was interesting from the Fed. The Fed themselves said, do government dollars drive recovery? Now, if I were to ask you to look at this chart, Brandon, and we're talking about maybe more cheap money, right? Money going back in the market, a rise in that the money that goes in there, because money is going to be king and we need that for those buybacks. If I were to have you look at this and you weren't looking at the titles of those lines, would you say that one leads the other? Does blue turn first or red turn first?
Probably employment population ratio, maybe.
Yeah. So that's the thing is if employment population ratio is turning up first, down first, that means that the government's money isn't doing anything. Yeah. It was already turning. It turned before. In fact, it was already in its uptrend before the money of the government starts kicking in. And so I was looking at this and saying, there's no real advantage. The only thing it does is makes your line steeper, maybe. Yeah. But even from the Fed, if you look at the data, do the government dollars really drive recovery? We turn recovery ahead of time. And, I'm a freehand economist. I'm not a Keynesian. So I spent my time in economics and focused on the freehand market. But these moves through here, even according to the Fed, the Federal Reserve, they show you that the turn up and the turn down, we were pushing money in here and it still collapsed, right? We were pushing money in here to record highs and it still rolled over. And we rolled up before they started putting money back in. So it's not really the same thing that they want us to believe, that they're saving the day and fixing the markets. Yeah. The reality is they're kind of not.
Well, see, the problem here is that, look, Social Security, I think Social Security Medicare is now 45% of the budget. Mm-hmm. We got a lot of military spending. Military spending is not creating, it's destroying, right? We're sending it and just getting obliterated. But the reality is that, look, if the federal government is going to borrow $2 trillion, that is $2 trillion less that's available for investment in stocks, in a business, all this stuff. So we think about, oh, government investment, but the reality is whatever they're spending, right? And they're running deficits, they're taking that away from investment in the real economy. So
Yep.
oftentimes we see the government spending actually yields less than but a dollar for dollar in terms of spending, in terms of real growth, and can actually be a drag on the economy. So,
And I appreciate that. One of the things to point out is I was talking about government investments, not just money in the system. Okay, we're not talking about money supply. So I just want to make sure that other chart was clear. Thanks, Brandon, for highlighting that. Yeah, so government
I didn't mean
investment
to, but
doesn't
I'm
do.
glad I did.
Hey, you're welcome.
I can stumble on stuff.
So I brought this up because you had this as one of your pages. Is there something you want to show here on
Well, so if you look at, for example, you can see the difference between the S&P 500 PE ratio and the Shiller PE. The Shiller PE takes kind of a smooth average earnings, because otherwise, when the market's down, 50%, it looks really, really expensive. So you don't focus on PE, you focus on the Shiller PE or the CAPE, whatever you want to call it. It's at a 36 handle. We're very close. We're above the last highs of the last 20 years. 2020 high, 22,000 highs are the very high point there. A lot of measures. Again, this doesn't provide timeliness, but it just provides a perspective that of how expensive, how much you're paying right now for earnings on kind of a smooth basis. And again, this is more preferable against the S&P 500 PE ratio. And those notorious current PE ratios take away, they do not count negative earnings. So that's always a big one.
Yeah, if you don't include negative earnings, it would skew it the other way. Then certainly that's changes the data quite a bit.
Yeah. But I mean, but
I
at
thought
the
this was
S&P, on the one on the left, the PE ratio, when you look at PE ratios for like the S&P 500 or the Russell, they take out the companies that don't make money. So because you can't have negative earnings, right? You can't have a negative PE ratio. So
right. No, I totally get where you're at. So here we are saying that we're at inflation rate. By the way, we did have PCE, personal consumption expenditure, come in exactly as expected. The market said, okay, kind of was a dud, which is normally not a dud. And, our growth rates, we're not really growing, haven't grown for quite a while. Our inflation says that we're at 2.97%, but are we? Look at our dividend yields. I thought that was interesting when you had me pull this up too, is that the dividend yields are at one of the lowest levels they've been at.
Yeah, I mean,
so
they've really, you go back 2 years, it was like 1.9, it was about 2% you'd expect from the S&P 500. We're down to 1.29. And again, with very low cash levels, if you're a company, you pay the dividends, hopefully out of cash flows or cash. Otherwise, you've got to liquidate assets, or you've got to start to grow your earnings more. And again, we're kind of at this point, we've spent ourselves in such a deficit. Valuations are so extreme right now relative to the past. I mean, it's a very troublesome time in terms of when you start to look forward, where's the market going to be? So if you're a bull right now, I mean, why are you bullish? Right? Doesn't mean you have to pull out of the market. We're not suggesting sell everything you have in stocks, but the idea is this may gain some perspective as how much risk you're taking.
Yeah, and when you see that the safety plays, the dividend yielding safety plays are kind of non-existent, and when you see that the bonds, like someone else commented, that we haven't seen the buy into the bond market, and we see that, where you're looking around, you're saying, where is the safe place to put the money? I think it's rotation right now. I don't think we're certainly not in a liquidation event, even with that sell-off. I don't think we're in a liquidation event, and I think we're saying, okay, let's find where we can get a regular investment, something that will produce something, and you're really not going to see it in PE ratios of stocks. It's not going to be in value stocks. It's not going to be in dividend stocks. And so you have to look for who's performing, and that's kind of where the only thing you can do is, and I hate to use a term that would cross over into the algos, but it is performance chasing. And the idea is that you have to find where the next rotation is, but there's a lot of things that aren't supporting that. And we talked about some delinquency, and I compared single family mortgages. We haven't gone into default there yet, so we're sitting on some value in the homes, but we don't feel like we can go after it because the rates are too high. So at some point, we'll see if that the low interest rates that people have sat on for so long starts to see increased defaults in mortgages. It's all in the credit cards, really, compared to everything else at this point. I did have one other fundamental before we get into some individual stocks. Do you have any other comments on your other slides before I?
No, again, just from an economic perspective, the Richmond Fed, the Philly Fed, I mean, even leading employment indications are all leaning to the downside. But right now, households, they're 57% weighted right now in terms of 57% of their assets are invested in the stock market. This is basically at a record or near record. So this is just saying, look, the household level, we are fully invested, right? We own 39% of the market, or 57% of our wealth is in stocks. This is a point where this is where by taking our discussion today, it may hopefully get you to shift a little bit in preparation for what may come, right? So it's just trying to temper those. You gotta outperform, you gotta underperform at some time. Either you're underperforming the last stages because you're not making as much, or you start to underperform during a sell-off, which is way more painful.
Yeah, and I was gonna say I love that because one of the things that in my deep currents class, so I always say we follow the first rule, and the rule number one is we don't lose. And so our goal here is that means we're not going to make as much. My brother texted me and said, "Hey, he has some money with an advisor," and said, "Should I be concerned that they didn't make as much money as the market did?" And I said, "Depends on if they avoided the drawdown." So you, like Brandon's saying, you either can outperform as a broad account, you either outperform in the growth, you don't capture all the 20, 30, 40% up moves, and so you underperform the growth, or you avoid the risk if you do it right. Now, there are people that are skilled and talented that they miss the upside and participate all the way on the downside too. So I do want you to be very careful. They underperform on both.
Right.
But generally speaking, you only underperform on one of those. I did think that, you talked about employment data. Here is the labor force participation rate, meaning what percentage of the US economy is actively employed in the market. And you can see, and I went back to 1980. I really don't care much about the 70s details on that. We can show it, but it's, back through here is a different story, the way they counted it. But so from the 80s, this is the lowest participation rate. And the question is, are we going to see this roll over? And when we see these drops, it's not only that we don't recover all the way, it's that we don't recover, meaning the workforce doesn't go back to total percentage. Each time we make a pullback and a new attempted move higher, to me, this is telling us that we have never really recovered, even from the 2000s. Every time you see a percentage drop, are we going to continue to move the total participation rate down? That means that we're seeing that right now, about 63 people are employed in the workforce compared to 38% that is not. So we're about 2-to-1 right now.
Yeah, I think it's an interesting chart because you go back, when did it peak? Approximately 1997-ish. I mean, when did the Fed begin? Right? In like, when did Greenspan throw out? You guys have ever read any sort of like essays from Greenspan and stuff back in the 60s? I'm like, this guy completely changed the stripes. But the Fed really kind of engaged in 1997 after the long-term capital management, Asian financial crisis. And the reality is that the economy has not been on great footing ever since, to some degree. The markets reflected that in gold terms. The S&P is only marginally higher today than it was in 1997, meaning your purchasing power of your shares in the S&P are not purchasing any more today than it did in 1997.
Yep. So in the end, smoke and mirrors.
Yeah, I mean, the reality is it just stresses that as an individual investor, you have to find value, right? The whole idea of indexing and buying the S&P and you're going to be fine. You're like the doctor that sells his practice for $1 million and wants to earn 10% off his returns year after year after year, and I'm gonna live off $100,000. And all of a sudden you realize, how am I supposed to be able to do that?
Yeah, you can't. Yeah, and I remember very distinctly saying that if you can start investing in your 20s, if you can get to $1 million, you're set.
Yeah.
Not the case anymore. You are not set. It's just not going to work that way. So
McDonald's paid about $1.50. I knew because one of our members worked at McDonald's in the 1960s. made about $1.50 an hour, $1.25, something like that. I'm like, McDonald's pays 10 times that today.
Mhm.
And again, they're eminently charitable, right? Because they're paying so much higher wages. No, we've just devalued our currency and created inflation, so it just costs that much more to live today. You could probably
Yeah.
raise a family back in the 60s on $1.50,
Yeah. I tried to tell my kids
early
that
60s.
yeah, in our age group, I know you're close to my age. When I was a lifeguard, I got paid extra, and because lifeguards got paid more than the rest of the staff at this location, and I got paid 405, and that was like the pay bump. So
Yeah.
and so we were like getting, ooh, I get paid more than everybody, 20% more than everybody else. And yeah, it was higher wage, and that was considered a big deal. And now we're 5 times higher than that, easy. So
I got a $1.30 harvesting, $1.50 harvesting chickens, and
I
when I was in 13.
yeah, I did cherries, so I'm glad I didn't have to harvest chickens.
Oh, I
Um,
love doing cherries because make $1,000 in a couple of weeks,
I thought
like
I was
80
making a
hours a
ton of
week,
money. Yeah,
100 hours a week.
a lot of hours. So a couple things. Let's highlight the Nvidia crowd, CRM, and Dollar General really quickly as far as earnings go. Obviously, this is another proof into the pudding here that Nvidia outperformed earnings expectations. Crowd did, and Salesforce did. All completely beats in the markets, and Nvidia just got knocked down like $200 billion worth. Dollar General warned quite a bit. I don't know if you read the whole thing as well as I
Yeah.
did, Brandon, but Dollar General said, in essence, their consumers, which a large portion of them make less than 35,000 a year, are struggling to the point that their sales or their losses, meaning from shoplifting and other things, are going up, and their total sales are going down.
And they're basically saying people are running out of money by the end of the month. Right. I'm
Yeah,
like,
that
they just can't afford. I'm like, this is a huge problem. CRM, I'm sorry. Yeah. CRM round trip gapped up, then boom, the door
yep.
closed on it. I mean, these are not the greatest responses we're seeing from these stocks. I mean,
Yeah,
Crowd
so
obviously
this
had the big sell off because of issues.
yeah, and I was just going to comment that the whole idea that if you beat expectations, and the stocks are going higher, it says you're outperforming expectations. If you beat analyst numbers and fall, that means you didn't beat expectations. The
Right.
market expected more from you.
The
And
whisper.
yeah, well, and you've I've come to expect a certain amount of outperformance from what the analysts thought. I come to expect a certain amount of success to drive this higher and higher and higher. So all right, we've got a couple of things we're going to go through really, really, really fast. I'm not going to go through all the symbols because we're going to, as usual, we're going to run out of time. I'm just going to highlight really quickly that we are still looking at being long ExxonMobil. You're still liking ExxonMobil?
Yeah, I mean, look, the risks in oil are to the upside unless the economy crashes. So we're not saying the economy is going to crash here tomorrow, but we're positioned in terms of very low inventories, and Exxon does everything soup to nuts. So, like, again, it's a broad-based play. It's the largest holding in XLE.
Yeah, it's going to pull up XLE and crude. Interesting to see that crude sold off everything it gained yesterday. So we could see this pull back. So be careful here. I like it at 116. I would agree with you on that. I like it at 116, but crude reversed everything that it gained yesterday. So
Yeah.
just be aware of that. Uh, I've put GLD on my list. I know it's been on yours for quite a while. I don't see any reason that we're not still leaning into this. And this may be what the market does in general. It's at the top. It just kind of sits here for
Yeah.
a little while, but we did roll back. So I'm not sure if we're not going to get a little more sell off. Um,
I mean,
can
off the
we highlight?
breakout back in mid August, I was kind of looking for 250. Haven't gotten
Yeah,
there
and then
yet.
we still have some upside, I think, in there as well. Both of us are targeting this ascending triangle type pattern. Um, but yeah,
UK's asking
I
about silver. Are you bullish silver, Blake?
am I bullish silver? I would say I'm going to be bullish silver. The concern I have is that silver doesn't seem to hedge out inflation the same way gold does. And silver and copper, it's like in between. Gold pulls up, silver comes up a little bit, copper comes up a little less until we have significant demand. That's why I have my price ratio of gold and copper here at the bottom. And as long as gold is up and copper is down, this ratio is kind of showing a stagflation. And so we're seeing that high prices and low demand are really what's kind of winning the market today. And so silver is kind of in between. Is if you're to Like, so they're all connected on the same rubber band, but silver, I'm not super bullish on. I'm still seeing it as and gold is an inflation hedge, and silver is somewhere in between that inflation hedge and demand. So
And
I'm not
if
that
things
bullish.
were if things were doing better in the market, right? I mean,
Yeah,
silver should be outperforming because silver is more of a commodity than gold is. So,
yeah,
and copper is even more of a commodity. So FCX in that case would be doing great, or like an
yeah,
SCCO.
yeah. So
I
I
like
was looking at,
FCX, but again, we dropped yesterday.
yeah, and see,
Um,
I'm actually bearish on them. I just like I put SCCO on my bearish chart. Um, and we're at fair price, so I'm not convinced that this is a big breakout. And 1,000, so there's quite a disappointing split. Why did they even split that?
I don't know.
I don't know what that was all about. Some bookkeeping issues there, but I like Southern Copper as bearish actually right now, and FCX possibly the same. But
FCX was really nice off the lows. We was tracking a lot of call activity off the lows in early August, and again, we're reaching the limitations that how much can we continue to push this growth expectation. That's what you're seeing kind of maybe withering on the vine here.
yeah, and I think overall this will tie in. I didn't put this on my list, but this is going to tie into possibly another leg down in China, the way I would read this, because China is a big manufacturing country. And if we see a decline in copper purchases and manufacturing, then I think FXI might come back and test 25 again.
KWeb was a disappointment. I thought we might get a squeeze a weaker, but the dollar did not weaken as much. And KWeb kind of broke back down. Of course, you've got your Babas, and those just didn't perform as well. But
Bob, is it overbought?
I do.
Baidu's down there.
Of course, you got Timu, PDD, and Duo.
Oh,
There's your Dollar
ooh,
General online store, right?
yeah, that's it.
Kids love to buy stuff on Timu.
That's because they like to sell their souls and their personal data for cheap stuff.
They like free crap. That's what they like.
That's right. That's exactly right. They live like a billionaire. All right. Hey, we're actually need to jump out of the way here for Don in just a minute. I was just reading through the chat. Again, I want everybody to understand we're not predicting the big downturn. It's what we're looking at is that the markets hit a peak. We're having a hard time finding where the money is, or people are having a hard time saying, can I go into the bonds? Can I go into dividend income? They're looking for places to put their money, but we're in a kind of coiling pattern on a lot of the traditional safe places to be. And this is a time to look for opportunity to rotate into safety, rotate out of some of the more leveraged stuff. And certainly Nvidia is selling off based off of it was overpriced. They just pushed it too high, too fast off of what kind of earnings they had. And those types of stocks, including CRM and Crowd, you're seeing that this was too high for the valuations they were getting, or the PE ratio, or what they're turning. And you can look at this. Did we expect to make 612? No. Did we beat expectations? Yes. By 10%? Sure. So it's not that we underperformed analyst ratings, that we as a market were disappointed. We wanted more from them and they just didn't deliver. And in the overnight, we've bounced up a little bit, but to me, this is going to, we've got mid move here, and either we're going to roll over at 121 and go for a new low, or we have to get through 121 before we can go to 125. But I still think the downside's stronger.
I'm with you.
Any parting comments, Brandon?
No, again, I think if you've experienced some difficulty over the last month, trying to pick direction, look, I mean, that's the problem right now, right? It's been a very, very difficult road, back and forth action. I mean, again, unless you pick the right stock at the right time, it's been much harder to pick direction. So again, this is where, just looking to rotate towards defensive oriented positions, looking to take profits into the strength, hedging the downside risks. That's kind of the name of the game right now, because again, we may see a 5 to 10% pullback in the coming weeks. We may not, but you got to be prepared for that scenario. Take profits into strength if you've got them, and recognize it's been a tough road the last little over a month.
Yeah, and yeah. So if it feels like you've been getting slapped one way, if you try to go bullish, slapped one way, it's going to go bearish. Yeah, it's because we did this kind of thing in the broadest markets and the broadest sectors and the biggest stocks. And we've gone back and forth, and the size of the moves are getting bigger. The swings are getting bigger. Volatility is getting bigger as far as the individual equities. And we're not getting paid enough to take that risk. So, all right. Well, we got a lot of day ahead of us, Brandon. We're going to get out of the way so Don can take over. Have a fantastic day, everybody. Thanks for joining us. Thank you, Brandon, as always.
Have a
It's
great
been
long
Friday
weekend,
morning.
everyone.
Oh, yeah. Long
Labor
weekend.
Day.
Monday's a holiday. We'll see you on Tuesday.
Have a great one.